Hi everyone, it's Valentina Sanchez Cuenca from the Bird Shops Report. I'm with the LATAM team. Today we're going to do an emergency call from the Lens. We have Robert Van Battenberg, CFA, he's part of our team, and our host, Larry McDonald and Craig Shapiro. Since 2010, we host an institutional live chat on Bloomberg with more than 660 investors all around the world. If you're interested in joining us, please email info@thebirdshopsreport.com. Thank you and enjoy the video.
Hi, thanks everyone for joining us. Little emergency call here. Dr. Van Battenberg is in the house. Robert, thanks for joining us. Craig Shapiro, great to see you, my friend. Let's kick it off, Rob. So we did a video this week about the bond market and about wealth destruction. And the point we make is that, historically, typically bonds give you a nice offset versus stocks. So the wealth destruction this time, with bonds not rallying and yields higher, the wealth destruction has been pretty powerful, even more significant than Lehman, even more significant than COVID. Rob, one of my points, and I want to bring you in here. My main point is, since 2022, because bonds are not giving investors that kind of normal historical protection that they did the last 30 years or so. Over time, we're concerned, and we talk about this in our book, How to Listen to Markets Speak here. I think we make the case that human behavior can change over time. In other words, if duration, long-term bonds don't give you that protection on the downside, then over time, there's kind of a decay. Why should investors buy 30-year bonds or 10-year bonds? Rob, what are you seeing in the market? What did you see last week? We did a systemic risk alert last week, and what did you see in the bond market? Let's bring up that first chart, Jose. Rob?
Right. So yeah, we pointed out this weekend that the basis trade, which is essentially a powder keg, which is lurking underneath the market,
and just basically, for the beginner, what is the basis trade and what happened in 2020?
Yeah, it encompasses many different trades, but one of the big ones, of course, is to short the future and go long the treasury cash. And the positioning you see there in the chart is the futures positioning, which is reported by the CFTC. And it shows that speculators are massively short the future. Now, that doesn't mean that they're short the bond market, they just are short the derivative, and they are long the treasury, the cash treasury against it to play that spread.
And this is, Rob, this is large hedge funds. So in 2020, we had a number of large hedge funds, and this problem was so big that it forced the Fed, right, into capitulation. And then, this week we had politicians in Washington, Trump capitulated. So in other words, we're looking for what brings politicians and central bankers to capitulation. Is that kind of your point?
Yes, that's the bond market. Trump said it himself in front of the White House a few hours after he caved. He said he listened to Jamie Dimon in the morning, and Jamie Dimon said that the bond market was getting anxious, and he was getting, people were getting jumpy. So I read that both Scott Bessent and Howard Lutnick, who are both in the administration, are polar opposites of the ideological spectrum within the thinking in the White House, went to Trump and said, you got to stop this because the bond market is blowing up. And this week we pointed it out because this is exactly why the Fed went all in March of 2020, because the basis trade was blowing up and it cost me a massive amount. We saw that limit down day in and day out during those dark days in March of 2020. And that was risking happening again.
Now, Rob, another thing that's going on, so we run an institutional chat with investors in more than 20 countries. Craig Shapiro runs our Discord room. So if you're coming off a flight, if you're out of a long meeting, you want to jump into our Discord room, especially in a busy market like this, reach out to info@thebeartrapsreport.com, info@thebeartrapsreport.com. Rob, on this swap spread issue, this is really important for everyone watching us right now. In 2023, we had a banking crisis. The Fed created a facility which was like a massive fire hose and put out that crisis. But for the love of God, remember that a lot of banks still hold on their balance sheet what we call an HTM, hold to maturity bucket. And that's a lot of long-term bonds potentially. And those bonds, if they need cash, they have to sell them in a crisis. And so one of your points that you made last week to our institutional clients, Rob, is that the fear is that Trump kind of pressing this tariff weapon against the world, the banks, because of volatility in the market, because of a lot of things that are happening in terms of risk off, banks need cash, liquidity goes down. Rob, you're hearing that banks have been forced to kind of sell down this hold to maturity basket, and how does that relate to swap spreads?
Yes. So when Trump won the election, with a lot of speculators and hedge funds and all kinds of bond market participants that were believing that the swap spreads would actually widen because Scott Bessent had the idea of, through their deregulation, allowing banks to buy more treasuries. He wanted to use banks, the balance sheets, as a source of demand for treasuries in order to suppress long-term interest rates. So a lot of these participants went long the swap spread, meaning that they were anticipating that swap rates would go up vis-a-vis treasury cash rates.
Okay, so let's simplify that. Let's simplify that. So if you're a bank, you can hold a bond, a U.S. Treasury, or you can hold a swap. And if there's a liquidity crisis, sometimes you might want to hold a swap versus a Treasury because you need cash.
Yeah, so this reversed dramatically in the last couple of days because banks got called by corporates. They needed cash, so they needed to have access to the liquidity that in their deposits. So banks were selling treasuries, but in order to maintain their interest rates exposure, they swapped those they bought swaps against it, and it requires a lot less collateral. So they raised a lot of cash selling those treasuries, which pushed these treasury prices down, yields up, and that spooked the market in a very strong way.
Okay, let me bring in Craig. So Craig, you've been running the Discord room and the institution, you work in the institutional chats. You're talking with some of the most impressive investors in the world. And I noticed you pointed this out last week as well around swap spreads. What's your take on that, Craig? In other words, banks need liquidity, so they'd rather get into swaps than treasuries?
I think it's multifaceted. I think you brought up a good point. Corporates and bank customers need cash. Part of the reason that corporates need cash is because of the tariffs, because working capital needs are now exploding, right? If you're a company and you need to go and import or you need to buy goods and now tariffs are 10% higher or 125% higher, you need to extend your line in order to buy as many products. And so you're drawing down on your credit facilities. And so you're asking the banks for cash. And so you have this ball of spiraling effect, basically, as corporates need more money. You also have credit spreads, which are widening out. And so sometimes credit is used as collateral. And so the value of that collateral is going down. And so you have to post more collateral, which is drawing things down. So you've kind of created the tariff uncertainty, and the magnitude of the tariffs has created a run on bank cash. And so I think that was part of the dynamic that we've been seeing over the course of the last couple of days. And what happened earlier this week, obviously rumors about whether China was selling treasuries or Japan was selling, whatever it was, the bond market started to really freak out.
So Craig, think about this. Like, you're the White House, right? You've got a brilliant guy like Scott Bessent. Essentially, a month ago, was kind of on the bench in the tariff stuff. So you had Navarro and Lutnick running the show. Nobody went to the president of the year and said, hey, guys, like, if we do this aggressively, we're going to create systemic risk and we're going to be probably embarrassed.
Yeah, look, I mean, the post-mortem on this is that this was all planned, which and that the president and everybody knew this was going to happen, and that they knew this is the way to negotiate. And we were going to basically really show the world that we were serious with these reciprocal tariffs. But I think that's a bunch of BS. I think that's not the case. I think they drastically underestimated the impact of the bond market here. They drastically underestimated leverage in the system. And they thought that when they came up with this announcement last week that the markets would be choppy to down, but it wouldn't lead to a bond market sell-off. They thought that the growth slowdown coming from tariffs would lead to a continued flight to quality and that bonds would rally. And that's the trend that they had been seeing, to start the year. Every week, Besson had been talking about getting yields down, and yields had been coming down for, since the inauguration. So there was some certainty around that. And so I don't think that they were planning for this. And I think that was a big mistake. They're trying to cover it up now by saying this was always the plan. I find that very hard to believe. But I do think Besson kind of did interject here and said maybe it was over the weekend. There was talk about him flying down to Mar-a-Lago. I think he suspected things were maybe starting to spiral a little bit or about to. And so, talks began. And clearly, to Rob's point, the bond market is king, right? When the bond market starts to get disorderly, somebody needs to act. And either the administration needs to act or the Fed needs to act. And I think in this case, the Fed is on the sideline, right? The Fed has said they are not ready to interject here. They've seen smooth market functioning. They mentioned it in speeches this week and last week. They don't really see any reason. There was a paper out about the basis trade and potentially creating a facility in the future.
Craig, just hold on for a sec there, because when I talk to the institutional clients in the chat, that Fed line is complete BS. Okay, the Fed, they're on the sidelines. First of all, December 2018. They pounded the table that they were on the sidelines. And like a week later, the beast in the market, the serpent in the market, body slammed the Fed. And I think the same thing is happening now. Rob, what's your take?
Yeah, no, the Fed, obviously, they watched it. In fact, I think one of the Fed speakers, Schmidt, just admitted that they were watching. Liquidity never really recovered after COVID, right, in the Treasury market. So that's been the bane of that. There's been a real focal point of the Fed. What we were talking about, the basis trade and how it has mushroomed, how it has become such a behemoth. That is also, to Craig's point, right, they did a paper on that. They're trying to tinker or change some of the regulation around their repos in order to try to get people out of that basis trade because it can blow up. And now we saw it again. It was on the verge of blowing up. And when you have, I say, a 1 trillion, maybe it's more of basis trade, under the market. And,
Rob, potentially dozens and dozens of funds are in massive, massive trouble. Potentially. The carnage yesterday in the mortgage-backed securities market. One of the clients said it's the worst he's seen in years, even worse than 2022. So the mortgage market. Hey, Jose, can you go back and bring those last two slides up, the gold slide and the curve? And so one of the things we talk about in our book, How to Listen to Markets Speak, is gold, right? So financial assets and hard assets. So think of the portfolio construction from 2020 back to 2010. When you're in a disinflationary regime with low bond yields, everybody wants to be in growth stocks, and that's been the case for a long time. But when you go into a 1968 to 81 regime with higher bond yields, more global conflicts, you want to be in a portfolio that's more long hard assets, okay, than financial assets. Stocks are just paper certificates, right? In a 1968 to 81 regime, and we made the case in the book, we've moved into a totally different regime, but everybody's still in the 2010 to 2020 portfolio. Rob, how do you read that?
Yes, we wrote a book on that. Look,
but what triggers that?
We did a simple calculation then, right? Yeah. The entire amount of gold above ground, and you divide on top of that, the numerator is the amount of the stock of dollars, right? So what is gold worth in that equation? And we came to the conclusion then that gold would be worth $3,300 per troy ounce. At that point, it was worth 24. At that point, it was trading at 24 or 2,200 per troy ounce. Now it's 3,100 per troy ounce. And the gold stock has probably increased. And I think, we discussed it in our last call as well. Once you realize that, countries, Europe, the United States, they're in a debt cycle, they have to debase their fiat currency constantly, then the value of assets like gold will continue to go up.
So Craig, so one of the things we talk about in the book is the DCF model, discounted cash flow. So if you move into a regime with higher bond yields, then think about how you value companies. Think of two different companies. Think of a software company that has no hard assets, just intellectual capital, right? And then think of not just a gold miner, a copper miner, an oil company with lots of assets, hard assets. Think about those two, the valuing those companies. Craig, when you go into a higher interest rate regime, explain how hard asset companies tend to outperform because of that DCF model.
Yeah, I mean, think about these growth companies, these software companies. Most of the value is in the terminal value of the company, right? People run a 3-year or a 5-year DCF, but it's the future. It's companies that can grow 50% a year or what have you. And so low interest rate environments create, large terminal values. And so that's how folks get, very comfortable with valuations on some of the big cap tech stocks and some of the, unprofitable tech stocks, because you're going to get paid for that future growth. But in an environment where the yields are higher, that terminal rate, that terminal value is coming down. You just don't have as much of that. You need the cash flows to justify, the valuation. And so typically what we see in these higher interest rate environments is shifts in portfolios from growth to value. Companies with hard assets, companies that are making money now, that are returning on their investment, typically will find themselves with getting higher multiples, and companies that you're banking on the future that need low cost of capital in order to survive are
Correct. Correct. NVIDIA, $2.7 trillion. The entire gold and all the gold and silver miners on planet Earth are only worth 400 million. I mean, is there a great migration of capital from growth to value happening now, similar, say, since 2000 to 2022, or I'm sorry, 2000 to 2002?
I think for sure. We're moving here in America under Trump and these policies to really try to bring back manufacturing, to try to bring back capital investment here. He's touted, $5 trillion plus of new investments that are coming, and that number is going to, continue to grow exponentially if we're going to have these tariffs on. So, companies that build things here, companies that put equipment to make plants to build things here, that whole value chain needs to be built out. Versus, some of the software companies and the cloud companies, that don't require that high capex, that need low cost of capital in order to keep growing. We are going to see that continued rotation. And as far as gold and gold stocks are concerned, the collateral value of the U.S. Treasury security is declining amidst this uncertainty, amidst this chaos. And so globally, countries are going to be looking to increasingly store excess trade balances in things other than U.S. Treasuries, and gold has fit right in there, and that's been part of the story here.
Hey, Robert. So in the last 20 years, when stocks crashed, bonds rallied, right? So yields came down and bond values went up, right? And that's what we call a bull steepener. All that means is you have the 2-year bond versus the 10-year, 2010, 2020, the last 20 years, every time stocks sold off, interest rates went down and bond prices went up. And that gave investors $3 to $4 trillion of protection in the Lehman years and the COVID years. Today, that's not happening. What's going on here with the curve, Rob?
Well, that's part of the story, right? The curve steepened so much, and it's steepening again today because there clearly was very much pressure on the long end. Again, banks were selling treasuries. You just showed me the chart of the direct participation in the auctions, both on Tuesday and on Wednesday. They had disappeared, right?
Yeah, let me go back to the auctions for a sec. This is important. I forgot to mention that. So you're really solid on this. I know you talk to our clients every time there's a bond auction. This year, the banks have been pretty busy in the bond auctions. But you've noticed, and you shared this with clients last week, and this is part of our systemic risk indicator. You noticed that there were less banks participating in the auction.
Well, there were none, pretty much none. It was the 10-year was 1.6% was taken by direct buyers. In fact, indirect buyers, which are the sovereign wealth funds, Japan, China, they took an extreme high amount as percentage of the overall allocation because direct buyers were gone. So basically, I'm sure
does that mean there's like a cash crunch at the banks? That's another systemic risk indicator?
There is no more appetite to buy treasuries. As Greg and I would discuss, we pointed this out already, they need cash. So they were in the market selling treasuries, and with potential severe implications for the basis trade, right? If that actually starts to revert, right, and then all these speculators have to rush in to cover their short in the treasury futures. It could cause a calamity, and so the bond market has basically pushed Trump back into the box. He had to back away, and that's where we are today. So it's a very powerful set of events.
So what are you trying to say in this chart? What are you trying to say in this chart here?
This is the direct participation. See, it went from 25% in the previous auction to 6.2%. This is on the 3 years, so it's not as extreme as Wednesday's, which was 1.6% participation.
And who's participating? Who's participating here? I can't read it.
The banks. So this is bank.
This is bank participation.
Yeah, the banks are the directs, and the indirects are China, Japan, and then you also have dealers that come on top of that. Those are the three groups of people that are buying in the auction. So the indirects, China and Japan, okay, fine, they were good, but then you have the direct participation, which basically collapsed. So that means banks were no longer buying the treasuries out of the auction. And that is a clear signal that they were selling. Right?
So, Rob, and we talked about this in the book, right? How to listen when markets speak. In this kind of regime, I think from this going forward, investors are going to have to pay a lot more attention to bond auctions. You need to talk to people like Robert Van Battenberg and Craig Shapiro. And when you see this bond auction participation, Rob, and you see this indicator here, one or two of the clients yesterday said, in terms of the indirects, you said that was strong. So it made it look like Japan and China were strong. But some clients thought, oh, Treasury called the Middle East, their friends, the Saudis, right? And maybe the Saudis came in heavy, and that made the indirects look firm, and that's partially why we rallied yesterday. Was that the right take or interesting take?
Yeah, it could have been. I mean, I don't want to be putting on a tinfoil hat, but if I was Scott Bassett, I would use and remember, the U.S. has a lot of leverage over Saudi Arabia, right? They asked Saudi Arabia to pump more oil. Saudi Arabia did it, right? They're going to Iran this weekend with a carrot and a stick. So Saudi Arabia is sort of like dancing to the tune of Donald Trump. So Trump calls, look, you got to buy a lot of these bonds, these 10-year bonds that are coming up for auction this afternoon. I need your help. I'm sure they're going to be in there. But removed from that, the indirect participation looked so good percentage terms because direct had disappeared. So the banks had disappeared. And that was a seminal moment because that was a signal that, okay, these banks are selling, they need liquidity, they need cash. And remember that Scott Bessett's vision was to create exponentially larger demand for treasuries from the commercial banks, right? He wants to lift the cap on Wells Fargo so Wells Fargo balance sheet can grow again. He wants to adjust the supplemental leverage ratio so banks do not have to put up collateral anymore when they buy treasuries. He needs more demand for treasuries. This goes completely against what he's envisioning. And like Craig said, they want the long bond yields down. So this is flying in the face of all that.
Yeah, every basis point they bring bond yields down is $1 billion in savings on interest. Every basis point the bond yields go up, it's $1 billion that it's going to cost the taxpayer. And So Craig, when you move into that higher interest rate, sticky inflation regime, maybe, tariffs cause an inflation bounce, that's the big fear. This chart, it should be labeled a little bit better, but all it shows is when the arrows are going down, that's big money, huge money moving from growth to value. And Craig, your point is that in like that 1968 to 81 regime with higher bond yields, higher, more sticky inflation, then that capital migrates from the large cap growth stocks over to the large cap value stocks. Is that what we're seeing here?
Yeah, for sure. I think what we're seeing is a secularly higher inflationary environment going forward. And certainly, that's different from what we've seen over the course of the last, or from the 2010 through 2020 period, or 2000, even the 2000 through 2020 period, with structurally higher deficits, with geopolitical concerns, with reshoring of manufacturing jobs in America, and this trade agenda. We're going to have a secularly higher inflationary environment. And so this idea that the Fed is just going to instantaneously cut rates back to zero amidst any small slowdown in growth, which is basically what you had from the financial crisis, through, let's say a couple of years ago. I think that logic is now out the window.
Greg, let me ask you a question. Let's look forward, because we spent some time looking back. Let's look forward for clients and investors, our friends all over the world. Let's look forward. Let's just say what Robert's talking about, he's been talking about the last 3 weeks, the beast in the market, the bond market, swaps, basis trade, whatever you want to call the catalyst. That breaks the Fed again, right? So far, they break the beast in the market's broken the White House and kind of broke the spirit of being Mr. Tough Guy. But let's just say it breaks the Fed. And what does the world look like a couple months from now if we go toward a recession, the dollar's weaker, right? All of a sudden, that plus tariffs, a weaker dollar, higher inflation, doesn't that kind of like create a whole new regime for portfolio construction?
Yeah. Part of the problem right now for the Fed is that amidst the uncertainty, them lowering rates does nothing. It's like wasting a bullet, because it's the cost of capital is not the deterrent for investing right now. Uncertainty is the deterrent. And so as the economy slows, because there's uncertainty, the Fed cutting rates doesn't really do anything. We need to bring certainty back. And so I think the Fed is late, but the problem is, by being late, risk asset markets are getting concerned and are likely to get more concerned. And so I think that Fed put will get activated, but it'll be at much lower levels in risk assets first. And then eventually they will cut rates. They'll probably cut rates more aggressively. And if that is in concert with more certainty, a tax plan from the administration, and deregulation, then there's an outlook for a much more positive setup to exit this year into 2026. However, if this continues to go on and there's uncertainty on the tax side, there continues to be uncertainty on the trade side, and growth rolls over and the US consumer is just completely tapped out, then we go into a much more protracted growth slowdown, recession. Rate cuts don't really do much. The dollar continues to weaken. We will see that growth to value rotation continue, but it'll be amidst a sloppy market where stocks don't really do well, bonds don't really do well, hard assets like gold probably do incredibly well, and maybe individually, idiosyncratic single stock stories that are built on the U.S. manufacturing renaissance or rebuild, will do incredibly well. But there'll probably be a continuing repatriation of cash. Europe will look better. China will look better. Japan will look better. And so I think that's a dynamic I think we have to deal with. And that UX exceptionalism story being over, could really materialize further.
Yeah, at the end of the day, U.S. exceptionalism was massive deficit spending, right? 7% deficits, unsustainable. And we've done that so long and that's what we talked about in the book, How to Listen to the Market Speak, is we've changed human behavior on bond buying, right? That's why stocks are down and bond yields are up and bond prices are down, because we're actually changing conditioning, because for the last 2-3 years, you didn't get any love. Every time stocks were down, bond yields have pretty much been higher, especially in 2022 and now. So a lot of investors are saying, why own long-term bonds? It's not going to give us that protection. Robert, so we have a model, our capitulation model, that tracks like tension in the markets. One interesting thing around the new lows, you want to track the NYSE new lows, and for that buying opportunity, that real buying opportunity typically happens when you get up toward that COVID level of those new lows. So far, we've had a lot of stress, but in terms of our 21 Lehman systemic risk indicators and true capitulation, we're just not quite there yet, Rob. I mean, what's your take?
Well, I mean, individual investor sentiment is as bad as it was in February or March of 2009, right? The CNN fear greed index on the S&P yesterday before Trump's cave was 3. Like, yeah, I mean, the bottom is 0. So I don't think it's ever gone to 0. So there's a lot of negativism out there. I think it also has to do with the media. They've never been a friend of Trump. So every misstep he makes, they over-exaggerate it, they emphasize it. The market obviously lost $10 trillion in market cap since February, right? That's next to 2022. That's the biggest market cap loss ever. So,
Right, but one thing I hear of, and this comes from the institutional clients, retail investors are still pretty much in the market. In other words, there's been very retail buying, especially on the dips, has been heavy. So that's an indicator that kind of, the more inexperienced investors are still in play, and then you're not quite at a bottom yet.
right. Also, we track the amount of stocks in the S&P 500 that are below the 30-day, below the 30 RSI. So that until recently was rather muted, but as of last week, it spiked to, I think, about 250. So half the stocks were below an RSI of 30. These are kind of indicators, okay, that show the market's getting very oversold. Can it get more oversold? Of course it can. But one thing that we do know, and one thing that's very important, and I want every investor to understand that Trump, when he started this trade war, he made it very clear he doesn't care about the market. He says, I don't even look at the stock market. That changed yesterday. He said he was bragging how the market went up, one of the biggest gains ever in the stock market. So he's looking at that thing right now.
Right.
So whatever your worst case scenario is, you can take that off the table, because the worst case scenario is Trump is going to push this thing into a recession because he vehemently believes that the United States has to lock horns with China and the rest of the world on the trade deficit and a strategic, I need to protect the strategic industries, and that's all good and well. But that is off the table right now because he is either dictated by the market, or he basically realized I'm destroying too much value and I'm going into recession. And what's the point of that? Remember, the media will never, ever fail to remind him that he will be the president that had 2 recessions under his belt. 2, not 1, but 2. The only president ever. So he doesn't want to do that, right? He's at the end of the day, he's a business guy. So yes, the market could get lower. We're going to get spooked. There's more, tits for tats with China and everything. But he pays attention to the market now. He has no choice.
Right. And Craig's been with us for years as an advisor. And Craig and I had dinner years ago, 2-3 years ago, and Craig made the point that the 60-40 portfolio is most likely going to be over. And that people started to realize that in 2022 when we had that higher inflation regime, that higher bond yield regime. Craig, explain this. So the 60-40 portfolio is 60% stocks, 40% bonds. And that's essentially what the R par is, this ETF here. Craig, what was your thinking that the 60-40 portfolio would most likely move toward a 30-30-30 portfolio, 30% stocks, 30% bonds, but replacing commodities in there?
Yeah, I mean, the investors' allocation to fixed income and to treasuries and to just broad bonds has been 40 60-40 and been 40% for such a long time. But amidst these deficits that we've been seeing and have been accelerating, U.S. government borrowing is crowding out the rest of the world borrowing. We're also now going to get borrowing from Europe. We're going to get more borrowing from China. And so we're going to get more borrowing across the world from sovereigns, which is going to necessitate, even more capital. And so it's going to be a higher interest rate environment, which is going to mean it's going to get tougher to make capital appreciation returns in bonds, which has really helped a lot of portfolios over the course of the interest rate reduction period from 1982 through 2021. So you're not going to pick up that extra capital appreciation from bonds. You can still be in some bonds, because corporates and countries will pay you back. The question is, in a higher interest inflation environment, are you getting paid back a strong positive yield, real yield?
So
the
portfolio looking forward, instead of 60-40 stocks bonds, as we talked about in How to Listen When Markets Speak, most likely we're heading toward a 30-30-40, where you actually might have 40% of your portfolio in commodities. Because if you look here, Craig, that's the 60-40 portfolio right there, pretty much, right? Risk parity. And as you can see, you're talking about years of lower highs. And so the beast in the market is obviously impacting the Fed and Trump, but the beast in the market is also impacting portfolio construction. Is that your message here?
Yeah. The other thing too is part of the reason that 60-40 worked was from a correlation perspective, which you mentioned, right? When stocks went up, they went up more than bonds went down, and when stocks went down, bonds went up. To offset some of that loss. In the current environment we have now, stocks and bonds are moving together. They're much more positively correlated. So when stocks are up, bonds are up, and when stocks are down, bonds are down. And so you're losing that diversification benefit from having such an outsized percentage of your risk in bonds. And so you need things that are going to offset that correlation. Commodities, particularly gold and other hard assets, are exhibiting more negative correlation characteristics.
Now, explain what negative correlation means.
Yeah, basically, when something goes up, the other thing is going down, as opposed to positive correlation, where both assets are moving in concert together. So when things are positively correlated, you're basically just you're doubling up your risk as opposed to defraying some of your risk. And so having a diversified stream of securities that have different types of correlation profiles to each other lowers your overall risk. And so in this current environment we're moving into, where bonds and stocks are moving much more positively correlated, you're enhancing your risk by running a 60-40 portfolio. It behooves you to have other assets that are more negatively correlated. Commodities have acted in that regard, particularly gold, right? We've seen in this most recent sell-off for stocks and bonds, gold has gone to all-time highs, right? That would really have benefited your portfolio and your overall portfolio construction and your risk profile by having a larger allocation to gold than you've had in the past.
Now, one of the things that clients remind us all the time, that some of the great rallies of all time have taken place near the financial crisis or just big drawdowns. In other words, 2000 or 2008. Typically, from 2000 to 2002, we had counter trend rallies of 30, 40, 20% over almost 14 times, right? So what happens is, if you go on the other side of the mountain, shorts have to cover, and you get these big counter trend rallies as shorts take profits. And there's a bunch of reasons for it. This week, Craig, because you can see this chart, I mean, the moves that we're seeing in yesterday's counter trend rally and the moves intraday are just like in that Lehman period, just like in that COVID period. Is that pretty much what you're seeing?
I think what you have is we've moved into a more of a bear market. We've moved more into a downturn. The euphoria around Trump being elected kind of crescendoed earlier this year, and we've rolled over, and the DeepSeek announcement kind of put maybe a nail in the coffin on valuations for big cap tech stocks. So you're now in this bear market for risk assets, and these counter trend rallies get activated when we find the put level for the administration to do something to slow down the pace of the decline, or we find the put level for the Fed to slow down the pace of the decline. And so what you get is these vicious counter trend rallies because of a put level that's been activated, like we saw yesterday with Trump. And so you get these counter trend rallies, and then they get sold off again as investors say, I still need to de-risk. I still want to get out. And then we wind up making lower lows and lower highs throughout this period until we get to more of a capitulation or a clearing event or something that says, okay, if it's on the Trump side, I'm changing course, or if it's on the Fed side, we're taking rates back to zero. Whatever the case may be, we get a high volume capitulation. We're further through the growth deterioration. We start to see the path for more certainty in the future, and then investors can get more comfortable. But right now, amidst all the uncertainty and having just activated, the Trump put here, we're seeing it now. Markets are starting to sell back off again. And look, it's possible this afternoon or over the weekend, Trump will say, I had a great call with Xi. We're taking off 20% of the fentanyl tariffs. And then boom, the stock market and the risk market will rally back again. We'll have a vicious counter trend move. And then people will say, okay, well, where are we? We still have 100%.
Right.
And then we make it. So that's the choppiness with the downward bias that we're going to have until more certainty is upon us. And that's probably going to take another 3 to 6 months to really get through. I mean, even for the Fed has really talked about, not really having clarity on the impacts for at least 3 to 6 months. So we're gonna be in this chop with a downward bias, I think, for a little bit.
So thank you, Craig. Rob, one of the things we talk about in the book is the oldest baby boomer this year is turning 79 years old. The boomers control 79 trillion of wealth. The millennials only control maybe 8 or 9 trillion of wealth. Okay. So you've got 79-year-olds controlling 79 trillion of wealth. Let me ask you something, Robert Van Battenberg. You're 79, you're in your 70s. You just got hit with the tariff war and you lost almost 20% of your portfolio in a couple of days. What do you do? I mean, don't you? And all of a sudden, bond yields are much higher in this regime than previous than the 2010 to 2020 portfolio regime. So interest rates are higher, and you just got punched in the face in COVID and again here, and you're in your mid 70s. What do? Are bonds now, as bond yields go up, doesn't that pull capital away from stocks? As you can see here, the price to sales in the market, I mean, these stocks were trading at 41 times sales. And now, as we're talking about NVIDIA, now we're close to, I think, 18, still far, huge premium over the rest of the Mag 7.
Yeah, but NVIDIA's revenues went from 20 to 100 billion, right? So that brings down your price to sales level. But if you're a 79-year-old and you've lost 20% of your portfolio in the last few weeks, you need a new financial advisor. You shouldn't be in stocks when you're 79 years old, right? You want these are the people that are in bonds primarily, or very safe, like I don't know, CDs. But the wealth transfer is real. And we just heard that the Republicans did pass the Senate budget bill. So that was somewhat against the odds because we were all believing that there would be too much resistance in the House for this level of deficit spending. So now, it has to be reconciled and it goes through committees. So it will take another few weeks, maybe another month or maybe 2 months. But it's important for our viewers to understand that in that bill is...
Yeah, well, why should investors care about reconciliation? We're going to wrap up the call, but why should investors care and pay attention to this bill and reconciliation?
Well, that's what Craig said it just now. And by the way, and there are two reasons. Number one, there's a provision to raise the debt ceiling, right? So without that provision, without that bill, the United States will run out of money by July or August. Obviously, Republicans control both branches, so they're not going to let that happen. But that bill has to pass, right, one way or another. So that's a pressure point. That is a pressure on Congress to pass that bill. The more important reason why, which is what Craig was alluding to, is that this is fiscal stimulus. So on the one hand, you have the tariffs, which is an incredible drag on growth. If on the other hand, you have that fiscal stimulus.
Now,
right?
what is the fiscal stimulus? Tax cuts? Let's be clear.
The extension of the tax cuts. The whole reason, right, one of the rationales for Trump to actually start with this tariff war was not only for strategic ideological reasons, but also to raise the revenues to pay for this tax bill, right? Because in and of itself, this tax bill, but essentially over 10 years, costs $6 trillion. But the Republicans have such a small...
And that's because of the tax. Why does it cost that much? Because of the tax cut.
Yes. So without the tax bill, you're going to get a fiscal cliff in the beginning of 2026 because
Explain that for like just a basic new investor.
So in
what is a
Trump
fiscal
passed in
cliff?
2017, he passed the tax bill, right? The Tax Cuts and Jobs Act, which lowered tax rate across the board. And that was for about 9 years, $4.5 trillion that cost. That expiring by the end of 2025. If they don't renew it, it will be a fiscal cliff, meaning all these tax rates go up. So the idea of the White House was, if we get that, we're going to go into a recession. So why don't we levy tariffs on the rest of the world that pays for these tax cuts so we can extend them to avoid the recession? But of course, they came to the realization by the end of last week that they're going into a recession anyway. So what's the point? But it is important that now the House passed this because they don't have the commitment of these tariffs because they're all up, we don't know where they're going to land. So
in terms of revenue, you don't know how much revenue they're going to bring. Is that your point?
Yes, but they still passed it. So they defeated the resistance of the fiscal hawks in Congress.
And you're saying the House and Senate passed it?
Yes.
Okay.
Yes.
Get into how tight the House is versus the Freedom Caucus. The Freedom Caucus are kind of like your austerity crowd. They want to bring the deficit down, right?
Right. Yes.
And why are they so powerful? Why are they so powerful now? And how many of them are there?
Well, you have currently a majority in the House, 220 versus 213. So the Republicans basically have a 7-seat majority, which is extremely small if you consider that the fiscal hawks are about 30 House members on the Republican side. So if they would all say no, no bill would pass. But so that's in the House. In the Senate, they have a little bit of a higher majority. But I do want to mention this. This is one bill, right? A combined bill that the Senate bill that they passed. We still have to pass the ultimate reconciliation bill. So we're not there yet, but we're one step closer towards the finish line. And remember, this has to all wrap up in the beginning of the summer to raise that debt ceiling.
Okay. So in other words, we run out of money in August with the debt ceiling. Right now, we're issuing no net new treasuries, right? Because we're at the debt ceiling, so they can't issue more. They basically, every treasury that matures, every treasury bond that matures, they can issue one, but they can't raise any more debt. So
Right.
then in August, what happens in September, October, November, when, for the love of God, I mean, they're going to have to catch up on all that debt issuance.
Right. Yes, they do. We talked about this. So Bessent will have to open his bag of tricks to try to come up with more demand. Like I said before,
Isn't the Fed going to have to step in? Come on, let's get real.
That's why the Fed already stopped its QT for all intents and purposes, right? Last month. So they are planning to phase it out by the summer. God knows by September, they may actually have moved into a structure whereby they use the proceeds of the maturing mortgage-backed securities to buy treasuries. So they're in the market again buying that stuff. That's one way to do it. Like I said, Bessent could change the supplemental leverage ratio to have banks buy treasuries again. He could also suggest that the government should have less cash on hand, right? He had 800 billion cash on hand. He drew it down probably to 250 billion. Now everybody thinks you have to replenish it. He might say, I'm not going to do that. So those are the bag of tricks that he has. I don't know what he's going to deploy, but it falls on the shoulders of the Fed too to alleviate that wall of treasuries that is coming due.
Well, thank you, Rob. Thank you. One thing I'm really proud of is Craig and I, Robert and I produce every week The Turning Point. And it's a recap of the institutional chat. So if you're sitting at home and you want to know what is the buy side really doing? Well, what are the professional investors thinking, right? That's where Rob and I every week in The Turning Point, we send it out. and it's a real beautiful lens on a conversation between some of the smartest investors in the world. And I think it'll really help your portfolio. So if anybody wants to join us, info@thebeartrapsreport.com, info@thebeartrapsreport.com. If someone's interested in a lower priced analysis of one idea a week, Craig, tell people about the one idea and why it's so special.
Yeah, the one idea is an observation or a trade idea or something from that institutional chat that we deem to be of utmost importance. And so we really flush it out for investors once a week. We also have a proprietary risk indicator in there and some quotes from the chat. So it really gives individuals an introductory sample of the type of work we're doing. We also have the Discord room that I'm hosting, which really goes through that conversation through the day. It's in real time.
And what are the main benefits to the investor of those two platforms? Like what's in it for the customer?
Yeah, for the Discord room, I think is great for for folks who are looking to get an understanding of what's happening throughout the course of the trading day in a curated way. There's plenty of news from plenty of sources. We filter that and we provide information, what's happening, some analysis about it. We also give commentary from our network of the buy side of what they think about types of news, Fed meetings or tariff information or earnings reports. And so if you're an active trader and you're looking for more information in a curated way with some commentary, I provide my macro commentary in there throughout the day. The Discord channel is a perfect place. You get that all in real time. You also get our trade alerts.
So if you're like I said earlier, if you're getting off an airplane and you're like, okay, what's happening in my portfolio? You can call your broker, but with your iPhone, you just get into the room and get a quick download as to what's really impacting your portfolio.
That's correct. And you can message me or the team if you have any questions. And then the one idea is a little bit longer term. It's a little bit for those who are a little bit slower paced, not active traders, but still want some commentary and some expertise or an idea per week. I think that's a great introductory product for you.
Great. Well, thanks everybody for joining us. I want to say thank you so much. Our book hit #1, How to Listen When Markets Speak. It hit #1 this week in a lot of the financial categories. So we're really proud of that. And we'll catch you soon. Welcome back to The Lens. Robert Van Battenberg, the doctor. Thank you, Craig. And we'll catch up next time. Okay, thanks.
Sounds good. Thanks.
Thank you so much for watching, you guys. Thank you, Rob. Thank you, Craig. And thank you, Larry, for all of the intel. We'll see you next week. And